Time now for the markets with Zac Ashmore, who has a special report lined up for you in today's show. Zac?
Thanks, Mike. This week we're looking back at first quarter 2020. A lot has happened. It's already a year to remember. Let's see how the markets were in January. See that baseline? It's going to take a real dive as we progress. But first, let's see what the big news in trade was at the time. Top of the year, we were talking about African swine fever, the beginnings of COVID-19, still mostly confined to China, and the trade war between them and the U.S.
The markets are dominated by the funds, and price is still a function of supply and demand, but it's modified by the flow of money, so it changes how the markets operate. And with coronavirus, it brings back a lot of fears of the SARS virus in 2002 and 2003, where people quit traveling, commerce slowed down as a result, and therefore it was a drag on the global economy. And so the funds, they don't know a lot of specifics about the commodity. Some do, but a lot of them don't. And so they'll say, oh, slower global economy, less demand for commodities. So when coronavirus hits the headlines, sell commodities.
On January 15th, the Phase 1 trade deal was signed by the U.S. and China. Market effects showed an upswing that week in anticipation of increased exports and the softening of trade tensions in general.
For the Phase 1 China deal, that's been the much anticipated one, right? And the big story there is that, this is really the first significant step towards de-escalating the trade tensions. And we know that U.S. ag has been the hardest hit by the retaliatory tariffs. This particular deal it really addresses the non-tariff barriers more so than the tariff barriers for ag. So there's still plenty of work to be done on getting those tariffs back to previous levels, but it's a big step in the right direction for sure.
January 29th saw signing of the USMCA trade deal that had been in talks for the past several years. However, this time concerns over COVID-19 were beginning to grow, and although it had not yet reached pandemic levels, fears were beginning to spread.
So if we think about USMCA, Canada, Mexico, big markets for poultry and for meat coming out of U.S. in general. Now those industries can feel a little bit more certain that they're going to have those export markets moving forward. NAFTA was key for those for the poultry industry, and USMCA continues that and strengthens it a little bit.
Moving on to February. Early in the month, China began relaxing tariffs on imported U.S. goods. Trade talks with Kenya began as well. Markets were still slipping as uncertainty increased from COVID-19. On top of that, though, was the price of soybeans and corn affected by the Brazilian crop harvest.
Soybeans in Brazil are a lot cheaper than U.S. beans. China historically doesn't tend to buy stuff that's expensive if they don't have to. So why wouldn't you, if you were China, why wouldn't you buy the cheap beans to fill what you need for a while, wait and see if we do plant all these acres, do have a decent crop, which we have a pretty good tendency to grow crops under a wide variety of conditions. We've proven that the last couple of years.
By the middle of February, COVID-19 had become international. However, analysts were looking to the future, and planting season was on their minds.
We think it's going to be a weather problem here. We think it's going to be more of a drought-like conditions in the mid-late spring that's going to make early planted grains compromised and have the market who'd be trading early planting makes grain say, wait a minute, now all these early planted acres are not going to maybe be as good as we thought. We have to recalibrate. And so we think we're going to get a similar V kind of a pattern when we come out of that, and that gives us our opportunity to get a weather rally going like last year and get a chance to sell. Already the USDA has dialed down, cotton acres. So if the weather remains, that wet and that unfavorable, the cotton acres are going to be tough to bring in.
Finishing up with March, that's when things began to take a real downturn as COVID-19 began to quickly spread. By the 15th, shutdowns and quarantine brought markets to a heavy fall.
I think what more than anything coronavirus has done, it's added emotion. And it's been like a risk-off affair for those who are in stocks and portfolios, 401ks and different things, trying to find a place to protect or park money. But you're seeing a lot of money being printed by China and other countries, but especially China, to kind of try to cushion the slide of their economy at this time.
There's no question that the virus is putting a lot of people out to work. Restaurants are closed. In a lot of places, Illinois has no restaurant business except for takeout and delivery. So, when you kill demand out here for food, eating out, it's going to take a whack. And we saw that happen.
Closing out the month, things were uncertain. And although we're still in that situation now, it seems that the first quarter of 2020 is one to be remembered as an unexpected fall of the markets marred by an even more unexpected pandemic. And that's it for a deeper look into the markets. We'll see if the next quarter ends better. I'll be keeping an eye on it.